price drops down from in here, they leave relative equal highs. So what are they doing? They're engineering liquidity. This area here, can you agree that that is absolutely too perfect? Like, this is a classic example that would be in every support and resistance book. John Murphy would have this in his book, Technical Analysis of the Financial Markets, which is the Bible for retail trading. Every single one of you listening to my voice, you better have electronic PDF format or a hard copy of John Murphy's Technical Analysis of the Financial Markets. That book is the Bible for retail traders. And I am absolutely on the hunt for everything that's in that book. I want to be diametrically opposed to it. So how that would work is when the market was ticking like this and creates this little high, and as soon as this candle does that and closes, they're immediately going to put a buy stop order right there to buy on a breakout. When I'm reading price, I'm looking for areas where they have done that already. So here, they're long entered. I'm sorry, their long has been entered on here if they use the buy stop. So in this little area here, which just happens to be also yesterday's what? New day opening gap, which is for today's date. That's why it's dated here, okay? So retail would be long here, and they're feeling good about this because sometimes retail traders are in profitable positions. They don't necessarily believe, what I believe, but they believe that their indicators, their strategy of breaking out, buying momentum, selling momentum, that's the secret recipe, and it's not. You're just catching a little tailwind, but if you hold on to it too long, it'll turn back around on you. And what do? They see this, and it runs up, and they're hoping it's going to break out again here. They deny them. And anyone that bought on a breakout here, they're going to have their stop loss right there. So I have two reference points that I'm watching after I told my private mentorship group, 20,287. I want to see how it trades here. And if it's going to go below here, what can it reasonably go to? Well, this clear, obvious actual gap. This is a common gap. Okay? So this common gap is in close proximity to what? The original onset or the inception of the move, which is based on what? 1, 2 equal lows. So retail sees this as what? Support. So if anyone that went long on a buy and a breakout here, initially their stop loss is going to be below here because they see this as protection. It's being defended in their eyes. Anyone that would have trailed their stop loss would be right below this wick. So I have to watch and see, how does price behave? Does it go down to this level here? And if it goes below here, does it careen through that and dive into this? Because if it goes into here like that, then I know all I have to do is wait for price to book underneath these lows. So when it does this drop down in here, it's not only just going below the lows, but it's going into the upper quadrant of those dual volume imbalances on the daily chart. Remember I put the Fibonacci on it? Let me scrunch up the chart and you'll see it. The low of it, lower quadrant, midpoint, upper quadrant, and the high. Remember, it's the two volume imbalances that I'm encapsulating on that daily chart. But look what the price is doing. Not only is it just going below the lows, but it's going right to the upper quadrant of that level. So I'm anticipating, listen, I'm anticipating, I'm fucking predicting, I'm not reacting, I'm predicting the future. I'm predicting where my PD arrays are going to form. Now watch, folks. Anybody that's watching with supply and demand bullshit in their mind, watch. Really pay attention to this because I'm about to smash that shit on the rocks. A demand zone means that there's some kind of buying that's taking place, some kind of propulsion higher that sent price higher, so they're going to react off of that when it gets back down into it. Well, that just goes right out the fucking window because now we're below these lows. So where's the demand zone here? We're below all these lows. We traded down here. See that? On the 1 minute chart, I highlight the volume imbalance right here as the down close candle closes but doesn't take out that wick. Listen, because this is not supply and demand. Sam Seiden, take good notes, buddy. Take some good fucking notes. That volume imbalance is the first thing I draw out. I know that once we get above, as soon as this candlestick closes, it opens here. My eye sees that volume imbalance as this candlestick's closing like this. In my mind, I'm thinking, I want to see that candlestick close just like you're seeing it close there. And leave that volume imbalance right there. That's shaded, that little box, that little drawn out rectangle. I want to see that stay just like that. Because when it does this, I know that when this candlestick or the next candle after it would go up, it's going to come right back down into that level right there. Why? Why do I believe that that's going to happen, and why is it going to act as a discount array? Why should it be bullish? Well, the liquidity over here has been purged. We traded down to an algorithmic price point where if I'm going to be accurate about anticipating, predicting how a PD array is going to form, when and how they're going to form, it needs to go to a level that I anticipate having a reaction at. See, I don't trust in diagonal support and resistance, which is like diagonal support trend lines, diagonal resistance trend lines. I don't look at the market like that. I don't look at classic support and resistance. I'm looking at liquidity. I'm looking at levels that you're not necessarily seeing in your chart. This level here, this quadrant level, none of you are going to see that. You're not going to see that. No other school of thought is going to show you this level here. It's not going to happen. That's not happening, okay? So I have tools, I have resources in my repertoire that afford me a visibility over price that none of you have. And I'm showing this to you so that way you can appreciate, number one, that it's not just simply a down close candle that makes an order block. And it's not a demand zone, because a demand zone would have some kind of an anchor over here, and it's not. We're below the lows. That is not in supply and demand. And it doesn't just do a drop down into some random level. It's going to a level that I've outlined in a PD array that you saw in the live stream yesterday. So this down close candle here has a volume imbalance over top of it. The Indigo Entry Model is a run on stops order block with a volume imbalance on top of it. Okay, that's the Indigo Entry Model. That's all I'm going to say here. There's going to be more things to it, but you already know what's going to happen. It's going to be on Instagram. It's going to be on Telegram. It's going to be in Discord channels. It's going to be on YouTube videos. And there's going to be some kind of a booklet put on Amazon before we get to next weekend. Okay. ICT's Indigo Model entry. You know, stop that shit. Okay. Because nobody's buying it. It's not going to be taught in entirety until it gets in the print. But I'm showing you things that haven't been taught before. But it's leaning on logic that I've already introduced, which is what? There has to be one of two things happening for your entry. It's going to go to liquidity, which we clearly see, and I think anybody with the common sense can see that would be sell stops below these relative equal lows, right? I mean, it goes without saying. But if it's not going to liquidity to create the long entry, it's going to go down to a discount inefficiency, which is what? Here, that's an actual common gap. So in your chart, it could be drawn out like this. That would be a reasonable expectation, assuming that these relative equal lows were not there. Now, your question is going to be, well, how do you know not to buy in here? And how do you know they weren't going to just leave those relative equal lows there? Because sometimes you do trades and you short underneath relative equal highs and the trade pans out, or you'll go long in situations like this where there'll be relative equal lows and you'll get into a gap and you won't be fearful of getting stopped down here, because I'm teaching that breakdown to you right here, okay? Because we drop down like this and this swing low is sitting inside of that new day opening gap, that's already enough as a draw. There's several factors there for the price to at least want to get there. But if it's going to go there for the purpose of going below it for trailed stop loss orders, for anyone that's going long on a breakout here like retail traders would, to get below that, well, what's the first level? It would be the low of the new day opening gap, which is too insignificant for me. So what's below that? This common gap. Now, if this low would have went lower, then I'd be going long there. And it wouldn't be the Indigo entry model, or most likely probably wouldn't have done it. The Indigo entry is simply an order block inside of liquidity with a volume imbalance on top of it. Okay, so it's a culmination of several factors, but the main thing is it's going to liquidity. And I wouldn't have used this inefficiency here because these are too smooth. So if it's going to go below this low here, it's going to go into this gap, which watching it did. Then I simply have to sit and wait for it to get down into this liquidity. Once it did it, I want to see it touch that upper quadrant on those dual volume imbalances on the daily chart, which I told you about yesterday. Now imagine if I wouldn't have told you that yesterday. This would have looked like some mumbo jumbo bullshit, right? It would have been like some contrived, made up nonsense, right? And that's what some of these individuals that think that what I'm teaching has no validity because it hasn't been in any of their books. They don't have a hero to look up to. I'm an anti-guru. I'm an anti-hero. Okay, so I'm going to be divisive. But I'm teaching you the very things I'm doing that arrive at these stellar entries. And they're not linked to anything else. They're mine. They're all mine. And I'm lending them to you, okay? You don't own them. So no, I wouldn't buy in here. I want to see this trade to it and through it. Remember, every PD array isn't intended to stop price in its tracks. It's not designed to do that. It's to give you intel about what to see in price action. If it trades below this low, I want to see it trade into this gap here and go right through it like a knife through butter, hot knife right through butter. And it does so. So it means I know I'm going to be waiting for it to trade below these lows. And then where and how far below the equal lows am I going to reach for? The upper quadrant level. And then if I get an order block, the down close candle, in this case, we had the volume imbalance on top of the order block. So I'm highlighting that in the video. You watch me do this. So as price creates the volume imbalance and this candle trades up above it, I know that I'm going to see it trade back down into this area. Why? Why would I expect that? Because if you look real close, this is worth paid mentorship price and you're getting it for free. Isn't that awesome? This separation between this candlestick's body and this candlestick's body, that's the shaded area I'm highlighting. This candlestick delivery does what? It drops and lays down a body. How? With buy side delivery. See that? So when it does this, once the volume imbalance is created, and we're down here opening on this candle down here, it trades up. So what is it doing? It's laying down a buy side delivery body. So now what does it need now? What does it need? Read delivery down into this area. Watch the executions. As it's doing that, I'm going long. And as it touches in the top of the volume imbalance here, I'm going long again. I'm adding. And then this gap, I'm watching, do the bodies fill in and respect that area as well? So watch it over here. Look. It's missing buy side and sell side. The wicks, I ignore them because they do the damage. There's no body on this candle here. It's the open and close, the same thing. So I'm ignoring that entirely. My focus is primarily on the volume imbalance between these two. See that? So there are times when using the rules I'm giving you, and they'll be black and white, true, easy to follow logic. It's not always just this. There's other things you have to look for. But a volume imbalance is not simply just using two consecutive candles. You have to look at the same way I did the daily chart. Think about it. Is it any difference here? No, because the body of this candle is the open and the close. So what is it? There is no body. The low of the candle and the high of the candle here, and then the open and close is the same price. So if we use the open or the close and refer to it as the body of that candle, is it still same thing you're seeing when I talked about yesterday, where you have a volume imbalance between this candlestick's close and the open of this candle? That's a volume imbalance. It would look like this. Technical science. See that? Volume imbalance. And then the other one would be this. Yeah, how about that? That's a volume imbalance. But I'm teaching you to don't even look at it like that. This is how you look at it for real. Okay, so the algorithm is ignoring this candlestick entirely and focusing on this. That's the reference point. That's the array it refers back to. And you can see the bodies. I'm sorry, the price action in here. We wick outside of it, yes. But look what this does. Hammers it here, comes back up, rallies away. So what is it doing? We have an absence of buy side and sell side delivery on the body's perspective. We have wicks in here, but we have an actual gap between this candlestick's low and this candlestick's high. So there's a real separation or a real common gap. That's not my term. That's just what it is generically. When there's no trading in there, that is a real liquidity void by definition. This is a liquidity void. Okay, this drop down is not a liquidity void. This is a liquidity void because there's no printed mark-to-market orders executed between this candlestick's high and this candlestick's low. So that makes this a real liquidity void or common gap. Okay. Well, if you look what happens over here, we have sell side delivery through that, and then we have buy side delivery through that. See that? Big, huge paradigm shift. Ready? Watch this. It's missing both buy side and sell side delivery between these two candlesticks points, high and low, respectively. Sell side delivery, think about that paint roller analogy. You have paint on your roller and you're applying it to the wall and you draw the roller down. So you have really good supply of paint in that little white shaded area. Now you're going to start rolling the paint roller back up, and you see that happen on this candle. You see that? So between this candle portion here on the down close and this candlestick right here on the up close, price has been offered both directions. It's offered sell side delivery and buy side delivery. This little area now has become balanced. But what can still happen with the wicks? They can do the damage. So you have to refer back to that volume imbalance in its true form, which is here. See that? Now, I already know there's about 90% of you saying, fuck this shit. This is too complicated. I didn't get the algebra. I quit school. I didn't even graduate. This is bullshit. I ain't trying to learn this, man. Fuck this guy. I understand. I'm not teaching precision to everyone. It's only for the strong. You want to take trades like I showed last night, what I showed here? Look at them. Look at those executions. You see any market replay up here? Okay. That was done with live data. Live, not Memorex. So some of you are like, what the fuck's a Memorex? The delivery in between these two price points here. You want world-class trading? You want world-class executions? You can learn it from me, but it requires this. If you don't want to put this kind of level of work ethic behind it and try to study, you're never going to get it. You don't need this to be profitable. Don't mistake what I'm showing you here. You can make very simple bread and butter income and never, ever, ever go into this degree of technical science, and it gets further deep in the rabbit hole than this stuff. Like, this is still nothing. But if you want to go to the degree of world-class execution and seeing setups that the average bear in the industry isn't going to recognize or even anticipate, they wouldn't even know how to react to this type of trade. Like, they wouldn't even know how to do it. And I'm nailing it down. I'm nailing it down. You have to study what I'm teaching you. So the sell side delivery here in this small little white box, okay? What I'm talking about specifically is, see the top of the white box here? Look at where the black down close candle touches that upper portion of that white area to the lower area. That segment of the black candle coupled with this up close candle here. This portion of the white area, when it touches it and trades up to the high end of it right there, at that moment, this little area has become, what did I say? Has become balanced. But what can happen still? The wicks can do the damage. That means it can color outside of that white box. But look closely. Even though that we go back to that reference points of the actual volume imbalance here, my eye is watching all these things. I don't need to draw the lines. My eye is keying up on what I just showed you relative to this candlestick here and this candlestick here, which tells me that when this candlestick here opens and it trades down, I know that this is just a wick. It's not going to close down like that. It's going to open here, trade down, and come right back up, and then it closed high. Where's the body stopping at? It's inside of this little separation over here. It's on the high end of it. And then the next candle here, we open, we trade down, and stops dead in its tracks right to the tick over here. What's this candlestick's closing price? You're going to look up at this upper value here, okay? 20,229.50, so 29.50, okay? What's the low of this candlestick here? You're going to look right here. Look at that value. What's that candlestick's low? 29.50. To the fucking tick! To the tick! You awake now? Now you're sorry I got that audio fix, aren't you? Oh shit, it's fucking delicious. So when we see it trade down like that, what is it doing? It's doing the damage outside of this area that's been rebalanced with this candlestick here. But now let's go back in and see what it's done. Once you understand what you're looking for, you don't have to have the annotations on your chart. Your eye will just go to these things. But see how the body stops and rests on top of that white box? And the body stays above that white box? It only does the damage to the downside, stopping out anyone that wants to trail a stop loss up if they're absolutely long. And think about it. Think. Watch the recording. As the market's dropping down with that wick, I'm buying it. Think. I'm not worried about that thing careening down here lower, taking out what you might think is relative equal lows. I'm looking at how it took the liquidity out over here inside of a macro. What? What? What'd you say there? What time is this drop? When's it occurring? We're up here at 8:10. So we're in the last portion of that 750 to 8:10 macro. So where's the liquidity? Well, what has just happened? We left these relative equal lows here. So on this candle, we start doing what? Spooling. Remember that I give you a time window. That means it's going to start. It doesn't mean your trade goes to target there. It just means that it starts to spool. Spool for what, ICT? What does that mean? It means price is going to run in a direction to a inefficiency above or below, and or to a pool of liquidity above or below market price. So what has happened at that point? Look to your left. Retail bought a breakout. Retail trusts these relative equal lows. They think that's support. So the macro is going to go down and cannibalize them. Stop. Draws right to my level, upper quadrant, dual volume imbalances on the daily chart. Dual volume imbalances on a 1-minute chart. Same logic, same things going on here, okay? But when it trades down and creates this down close candle, I want to be trading inside of this open to its high of the wick. This little area in here, that is my order block. That's my prized entries. I want to have my entries thrown in anywhere inside of this. This is the watering hole. And I'm the cheetah. And I'm running down my dinner. I know that the market's going to offer time and price inside that little white area. So when price is in that area, I'm trying to capitalize by going long in it. And then I'm using this balanced price range here that was a former common gap. I'm seeing the signatures that this is exactly what it should do here. So anything on the downside, I wanted to add one more when it was trading down in here, but I had enough. I was like, okay, this is good enough. And then I set everything in motion. I added the annotations for the minor buy side liquidity pools, and then rally. Look at the delivery here. Look at that. Look at this candlestick over here. What's this candlestick's low? You're going to look at this value right here at the top of the chart. Look at this candle's low. 20,231.50. So 231.5. What's this candlestick's low here? 20,231.5. Folks, listen. Sam Seiden would fucking love it if he could have fucking had something that told you that.